GSK's headline numbers look like a disaster on Tuesday. Statutory operating profit collapsed 75% to just £481 million, down from £2.02 billion a year earlier. But instead of selling off, investors pushed GSK shares up 6% to 2,080 pence, their highest level since mid-April. That gap between the ugliest line on the income statement and the market's actual reaction is the story worth understanding. The collapse traces to one specific decision. GSK booked a £1.3 billion impairment after abandoning camlipixant, an experimental chronic cough treatment it bought into for roughly $2 billion 3 years ago, following 2 late-stage trials that showed limited efficacy. That is a real, cash-relevant write-down, but it sits apart from GSK's operating trading. Strip it out, and core operating profit actually rose 7% at constant currency to £2.80 billion, beating the £2.68 billion analysts had penciled in. So the provisional answer to why GSK rallied on a headline loss is straightforward. The market distinguished a one-off accounting write-down from the business GSK actually runs quarter to quarter. Turnover for the 3 months to June rose 5% to £8.41 billion, ahead of the £8.24 billion consensus, with core earnings per share of 50.5 pence beating forecasts by nearly 8%. The failed drug is a sunk cost. The trading business that funds GSK's next decade is what the stock reprised. The quarter's growth was concentrated, not broad-based. Specialty medicine sales grew 14% at constant exchange rates to £3.8 billion, with respiratory, immunology, and inflammation up 19%, oncology up 17%, and HIV up 10%. Vaccines rose 8% to £2.3 billion, driven by shingles vaccine Shingrix, up 3% to £888 million, and meningitis vaccines, which more than doubled. Respiratory syncytial virus vaccine Arexvy also more than doubled in sales. Against that strength, general medicine sales declined 9% to £2.3 billion, with the respiratory drug Trelegy down 7%. That divergence is not incidental. It is the visible edge of a strategic reallocation GSK's new chief executive is deliberately accelerating, shifting resources away from mature, established treatments and toward the specialty and vaccine franchises delivering double-digit growth. This reframes what GSK announced alongside earnings. The company is not cutting costs because the business is struggling. It is cutting costs because it wants to fund a deliberate pivot toward the growth segments that are already outperforming. General medicine's decline is the cost of that pivot, and specialty medicine's 14% growth is its early payoff. Understanding that sequencing matters more than the headline profit figure for judging whether the strategy is working. GSK launched a 3-year restructuring program called Accelerate Growth, targeting £1.9 billion in annual savings by 2029, at a total execution cost of £2.4 billion. Chief Executive Luke Meals said roughly 45% of the savings will come from simplifying processes and procurement, about 40% from reallocating resources out of mature products and into specialty and novel drugs, and the remaining 15% from the supply chain. GSK did not disclose a total headcount figure, saying job losses will be confirmed globally over coming months. Part of that reinvestment is a £400 million commitment to a new 300,000 square foot research and development site on the Cambridge Biomedical Campus, housing more than 1,000 scientists. It will replace GSK's Stevenage R&D site, a location the company has occupied for roughly 50 years, and only 5 years ago was expanding rather than closing. Stevenage is now scheduled to shut by 2029, with some staff moving to Cambridge and others to upgraded facilities in nearby Ware. The site closure and job cuts read differently once the timing is connected to GSK's biggest known risk. Dolutegravir, the HIV franchise behind Tivicay, Triumeq, and Dovato, faces patent expiry between 2028 and 2030, opening the door to generic competition against one of GSK's most profitable products. Meals has been explicit that savings will partly protect margins through that window, while the rest funds a doubling of Phase 3 trial starts this year, from 10 to more than 20 across 7 priority assets. The restructuring is not cost-cutting for its own sake. It is a hedge against a dated, quantified earnings gap already visible on the horizon.
The pipeline side of the bet has early positive readouts. GSK's Hansoh-partnered cancer drug Risres, an antibody-drug conjugate, met its primary endpoint in a Chinese Phase 3 trial for relapsed osteosarcoma after an earlier win in small cell lung cancer, with GSK's oncology head calling the results an important milestone. GSK is running a broader global trial program for the same drug, with more phase 3 starts due this year across oncology, respiratory, hepatology, and vaccines. Jefferies analysts described the cost-cutting plan as surprisingly strong, noting it landed at about double the scale the market had anticipated, and framed it plainly. The aim is to protect margin through the patent cliff, while also restructuring the business and relocating R&D from Stevenage to Cambridge. That external read supports the market's own reaction, a 6% share jump on a quarter where statutory profit fell 75%, because both readings separate the accounting noise from the strategic signal. What the fetched evidence does not yet show is whether the pipeline acceleration converts into approved revenue-generating drugs before dolutegravir's exclusivity actually erodes between 2028 and 2030. GSK's own £40 billion 2031 sales target and its reaffirmed 2026 guidance depend on that timing working out. For a holder, this quarter's rally reflects confidence that Meals' reallocation is credible, not proof that it has already closed the gap. The trials starting this year and their readouts as they arrive are the checkpoint that will show whether that confidence was earned.